I think we're reaching a point where the incremental movement of certain markets, incremental by that I mean you 4 steps up, 2 steps back, 5 steps up, 3 steps back, that kind of thing, is going to suddenly go away. And you're going to have certain markets literally leave the earth and other markets not. Okay. And I have good, solid technical reasons for that. And so far, we've been dead right. And I think we're going to continue. But I think a lot of what we're about to see will be chaos theory type action, not incremental upside or downside. It will be extremely rapid. There are certain triggers that we could look at that I can explain what they mean and why I think those triggers are the ones to watch, not simply looking at a price chart of the S&P, for example, or a price chart of gold. There's certain major asset class shifts that are about to be signaled that argue it's the beginning of something, not the end of something.
Something massive is brewing in the silver market, and almost no one is prepared for it. According to renowned momentum analyst Michael Oliver, the calm, predictable price action we've seen is about to flip into a completely different kind of market. He warns that silver's next move won't be slow, won't be steady, and definitely won't give investors time to react. Instead, he says the breakout ahead will be violent, fast, and without warning. With gold pushing toward new highs in early 2025 and silver quietly tightening into a powerful setup, Oliver believes the signals now forming are the same rare triggers that appeared before silver's most explosive rallies in history. And if these triggers confirm, he says this won't just be another upswing. It could be the start of a move that sends silver straight toward $150 and potentially $200 far quicker than anyone expects. Today, we're breaking down those signals, why Oliver says the real move hasn't started yet, and what investors need to know before this market takes off.
The triggers that I'm looking at, you're basically one of them is already at a pull level where you've already pulled the trigger. All you got to do is close the month where you are right now, and that trigger gets pulled. We can look at that first if you want later. And then the other one, there's another trigger I'm looking at that is close. And when these triggers break, it's telling us something is about to begin, not that the monetary metals, which seem to be have had an explosive move, which they really haven't. I can explain that too. Uh, it's just beginning. And it's not just a function of them going up, it's a function of another asset category going down. Because so far lately, you'll notice, except for January through April, when the stock market imploded 20%, gold shot up during that time. Total opposite to what the assumptions are. So did silver during that time. So you can look at both charts and sort of say, well, they're sort of all going up together. And they're really not when you measure them versus each other. And there's a signal structure that's about to be crossed that says that it just began. Something big just began. And it's at that point that my working assumption based on historical analysis is that in the 6 months following the trigger pulls that I'm going to show you, you'll see dramatic net price movements, especially in the monetary metals. Something that'll take your breath away.
Okay.
This one's different because this is monthly going back to 2020. The top chart, it measures an ounce to December silver right now is the contract we're looking at, and December gold. We rotate to the active front month constantly on this process. Anyway, we can see that back in 2020, when we had that huge surge in silver and gold shot up 40%, silver doubled in price. That was during that COVID period, and when the Fed came in and printed a lot. Okay. The performance of silver beat gold handily. It surged big from like 0.9% to 1.5%. That's like buying a stock at 90 and having to go to 150. Okay, same dimension. But over the years, since gold went into that range, after hitting 2000, price of 2000 in the year 2020, when this spread basically peaked, where silver was beating gold, during that period of sideways in gold, the silver and the miners tended to erode more. Instead of going sideways, they tended to back off. And therefore, on this spread chart, you see a decline. And the red line on the top chart, the spread chart, shows 1, 2, 3 hits on the line. That third arrow was September. October had a mild pullback off of that 3-point trend line, mild. It didn't drop sharply as it did prior in prior hits on that line. This month, you're out above it. So just on the spread chart, you're breaking a 4-year-old trend line. Now, there's also a flat ceiling. This is probably even more important. It's at 1.31%. Now, the part, write that down if you want to. Divide December silver into Dec gold and express it as a percent. Right now, it's a 1.23 or 24 right now. Okay. You get over 1.31 and you blow through that multi-year ceiling as well. So the spread at that point says, it's it. I'm gone. I'm going to beat gold now. I'm going to surge against gold. What's below it is our momentum chart of the spread. We like momentum because it usually leads price. In this case, spread chart is price versus price. Okay, the momentum chart measures that spread action relative to a 10-month average of the spread, and it creates this oscillator. And you can see the red line on that chart, two highs back in 22, 24, and also a low in 2020, all lined up perfectly, a perfect ceiling. You're pressing at it for the last couple months. You close out this month about 1.246% to get precise. Divide Dec gold into Dec silver into Dec gold, expressed as a percent. This spread blows out through a massive base. It says, I'm on my way. Again, this is a spread situation like the gold S&P that says, I'm just beginning. I'm not ending something. I'm just starting something. The last time silver had a spread breakout like this, where once the spread broke out, you gushed to the upside, silver beating gold, was in 1979 and 2010 to 11. That's when silver quintupled in price in 5 months in 79, summer 79 to the peak of the early 1980. It quintupled in 5 months. And in 2010-11, between the month it broke out and hitting its high in April 2011, it went up double and a half in 7 months. You break this spread out and we think, no, this is not the end of something starting, but it's a major explosion in silver versus gold. We're arguing that it's highly likely based on some other major factors. We can talk about them if you want. Just historical price ranges of silver that are highly distorted by monetary degradation in terms of where it should be. Silver could go to, I'm guessing, $150 to $200 in 6 months. Has it happened before? Yes. We ran charts of such base metals as copper and lead going back to the 70s, 80s, 90s into the year 2000. And they had a similar range as silver's had for 50 years, which is a range, $50, 15, $50, 10. You get my point. Never come out of that range. Copper came out of that range, multi-decade range in 2000, late 2005, and quadrupled in price in a matter of a couple quarters, and then lived in a new reality since then. Lead did the same thing after a multi-decade range that you could easily define on a price chart. Quadrupled to quintupled in price in a couple quarters and lived in a new range. How come silver's still stuck in its range of 50 years? There's arguments why it is. We
There
know
are
that
arguments
they are.
why.
Yeah. And when it breaks out, it's going to say, hey, there's overdone markets on the upside. I'm overdone on the downside. I'm coming out of here.
Michael Oliver's message to gold and silver investors in 2025 is direct and urgent. The real breakout has not even started yet. He argues that the early year strength in gold and the tightening price action in silver are not the peak of the move, but the setup for something far bigger. The key, he explains, is not the price of silver itself, but the silver to gold spread, a powerful ratio that reveals when silver is about to outperform gold in a dramatic way. Right now, silver sits around 1.23 to 1.25% of gold's price, far below its long-term historical average of 2%. Even in normal, quiet markets, the ratio tends to sit closer to 2%, and during major bull markets, it has surged to 3%, 4%, even above 6%. Oliver shows that this spread has been stuck under a 4-year declining trend line since 2020, but is finally pressing hard against the breakout zone. If it rises above 1.31%, he says it triggers a massive structural breakout, the same type of trigger that only appeared in 1979 and 2010 to 2011. Both times, silver followed with explosive, almost vertical moves. Historically, when this signal fired, silver didn't rise slowly. It erupted. In 1979, it shot up fivefold in just 5 months. In 2010 to 11, it surged more than 150% in 7 months. Oliver believes the same dynamic is forming again, only this time, the macro backdrop is even more supportive. Global silver production has tightened for multiple years. Industrial demand, especially solar and electronics, continues to climb, and geopolitical uncertainty has pushed gold to strong multi-month highs. Central banks are still loading up on gold, signaling deep lack of trust in fiat stability. All of this strengthens the foundation beneath silver at a moment when technical indicators are already flashing green. Oliver emphasizes that silver is the last major metal still trapped in a 50-year price range, while other commodities, like copper and lead, have already broken their decades-long ceilings and entered new price realities. Silver, in his view, is massively mispriced. Once it breaks out, it won't drift calmly upward. It will launch into a new paradigm. And this is his strongest message to investors. Those who think they've missed the move are wrong. Gold and silver's performance last year was just the warm-up. The real acceleration, he says, begins after the spread breakout. If gold moves toward the $8,000 level he views as reasonable in a currency-degraded environment, then even a conservative 2% silver ratio implies prices near $160, and a normal bull market ratio places silver near $200. Oliver's conclusion is clear. This is the fresh, defining entry signal, not the end of the opportunity, but the beginning of something massive.
And
Okay.
silver ratio to gold historically is 20 of the last 50 years, it's been 2%, even in at normal years, not even bull years. In bull years, it's reached 6.5%, 1980. And in 2011 bull year, it reached 3.5%. We're talking about 1.2. If you even go to the spread highs we saw in that 2011 bull market, you could take this spread up to 3% plus. That's a tripling in the relative value of silver to gold. And we're arguing when it occurs, it will not be slow. It'll be very fast.
Okay. So uh, you've got all these indicators that are showing that we are either at or very close to these trend breakouts,
Yep.
which historically have shown the multiple advances, the advances by multiples that you've walked us through here. So just to help folks kind of get a finger to the wind sense in their mind, you said, okay, if this plays out the way that it has previously, wouldn't shock you to see it would be a normal almost for gold to get to 8,000 an ounce. Miners would do substantially better than that. You talked about how silver could go to 150 or $200 an ounce pretty quickly, but that's only a tripling from where it is right now.
Yeah, maybe even more.
If gold got to 8,000, where would silver be around then, do you think?
Well, if even it were just 2%, you do the math. Because 2%, it's been there 20 of the last 50 years. You've seen at least reach 2%. Even if it just went to 2%, what's 2% of 8,000, okay?
That's what I'm trying to do the math on right now.
Yeah, okay.
I should be able to do that easily. Right, but
yeah, but the point being that
1% would be 80, 2% would be 160. Is that?
Yeah, something like that. But that's even cheap. When you take the real value of the money unit and factor that in. If you come back to 1980, now Eric Sprott, I think, has done this, and some other people. $200 silver would merely be getting up to those levels if you factor in the real degradation in the buying power of the dollar. So that would just be getting to normal. Usually when a market has been abnormal for too long, either too high or too low, when it goes and corrects and goes to a new reality, it usually goes excessive.
Right. When it reverts to the mean, it usually doesn't stop.
It doesn't stop at the mean. It goes way beyond, and then maybe comes back to the mean again.
Yep.
But so don't be shocked by what you see. I'm just arguing that when this occurs, it will be so rapid that if you're not already in this market, especially emphasizing silver in the monetary metals and silver miners in the monetary metals, which are likely to do better than gold and gold miners. Though, as we've talked about, the miners in general are a good place to be. I think silver will beat the whole thing and silver miners. They're off the page dirt cheap relative to gold miners. They're dirt cheap compared to gold. You got everything going for you, and you have a technical metric here that gives you a defining point, not just guesswork. There've been a lot of ups in silver here. You can see over the last couple of years against gold. They didn't take hold. This one will take hold because it's structurally defined.
All right. So for the person who is watching this, who has watched the precious metals have a great year this year, finally, because there's a lot of people watching this, Michael, who have held on to the precious metals for a lot longer than that and have the
Hmm.
scars to show for it. But for the people who weren't in the precious metals, saw gold and silver, be up whatever they've been up 40, 50%
Hmm.
plus this year,
Hmm.
the miners up 100%, and have said, shoot, I missed it. You're saying you
No,
haven't. We're just starting.
the game's just beginning, and again, you got to look at the relative performance relationship price level of the miners versus the S&P. Go back 50 years and look at it, and versus gold, you can see they're dirt cheap. They're like effectively you're buying something at $2 that used to be 100. Okay, it's effectively that. There's the risk on the downside, relative performance wise, is like zero. The question is, when are they going to wake up? And the triggers we're looking at right here, these are wake up triggers. And when they
Okay,
cross through those numbers, they're going to have a tantrum.
got it. And it sounds like what you're saying is they're waking up now, right? In other words, like
Yeah.
this is
Yeah.
not something that,
Mhm.
sit and think about, and maybe in a
Mhm.
year you'll be able to see what's going on. You're like this, they're shooting the gun now, and you probably want to think about getting in this trade
If you've
sooner than
never been
later.
in the monetary metals, this is literally a fresh investment grade signal that says it's time to consider shifting your money into monetary metals and or their miners.
Okay. All right. Well, look, if you don't mind, I'd like to go, we're over the hour. I'd like to go a little bit longer just because there are a couple of other key things I
Okay.
wanted to ask you about. We'll have to give them shorter shrift here, but I'm happy to have you back on, Michael, and talk at greater depth about them. So, you talked about one sector that's got your attention a lot right now, which sounds like it's kind of degrading, which is the financials. Let's talk about that briefly. Then I want to ask you about energy, because that's another
Yeah.
complex that has
Mhm.
been in the doldrums for a long
Yeah.
time. Do you expect that to rotate
Yes,
back into
yes, yes.
favor?
Yep,
Okay.
yep, yep.
And,
Uh,
and, and I'll ask you
which
this question when we talk about it, but even if the economy is falling into a massive
Yeah,
recession,
nope. Yeah. It's done it before. You got to go back and look at crude oil futures, go back decades, and overlap it with the movement in, let's say, silver, gold, and also the S&P, and you'll see recessions do not stop surges in oil, period. Okay. The Bloomberg Commodity Index can go up during a recession as well. In fact, it's broken out by our metrics of a 2-year basing pattern after that big run in 2020 to 2022. The war started, commodities came down, then they went dead for a couple years. So did oil. Now, oil is the weakest component of the commodity complex right now,
yep.
definitely. But it has trigger levels using our long-term momentum that suggests several dollars above where you are now, you start to trigger them. And when you get into the first quarter next year, if you want to be bullish on oil, you see it up around the mid 60s, get bullish because momentum says I'm going to explode out of this hole.
If Michael Oliver is correct, we may be standing at the edge of one of the most explosive silver breakouts in modern history. The technical triggers, the macro environment, and the long-term distortions are all lining up at the same moment, something that happens only a few times in a lifetime. And when everything aligns like this, the move tends to be sudden, overwhelming, and incredibly fast. If this breakdown helped you, hit like and subscribe to Metal Watch. Turn on notifications so you never miss a major update in gold and silver. Share this video with someone who follows precious metals. It truly supports the channel. Question for viewers. Do you think silver can realistically hit $150 to $200 in the next explosive breakout? Or do you think analysts like Michael Oliver are being too optimistic? Comment below. I read every response.